Welcome back to my channel and welcome to our series on business model innovation. My name is Roland Umloft. I'm an independent consultant and strategic CFO. In the last couple of videos, I've introduced to you the four-pillar framework of business innovation. So we've briefly gone through all the four pillars. And then in the last video, we also did a deep dive on the value creation pillar. Today, we're going to focus on value capture. So we will be talking about how to create a sustainable revenue framework for an innovation product. And this basically includes, your pricing strategy and your monetization mechanics. How did I end up in pricing? Basically, 15 years ago, I was, CFO for a SaaS company. It was my first CFO role, and it was the first time I faced a pricing challenge. Back then, I was looking around to, find some sort of canvas or some guidance, and I could not really find a lot. So this led, me to basically focus on pricing strategy, and it really motivated me to come up with my own framework. So today I will also be sharing my own framework with you and parts of that framework. But stay tuned. I will be providing a full series on pricing strategy on this channel as well. So as I said, today we'll be walking through value capture, pricing strategy, monetization strategy, and specifically with a focus on innovation companies. To start with, I will be showing you the four principal pricing strategies. So these are mainly driven by your objectives or by market objectives. And the first one is profit maximization. This is a more mature strategy, so typically not a strategy for a startup environment. So what you're doing is you're focusing on maximizing some business parameter, typically focused on profit. So here it's about highest price or maximizing gross margin, and then maximizing profit overall. The second strategy I'm going to show you is price skimming. So the idea here is that this is an early adopter market strategy. You have a very innovative product. You set it at a very high initial price. You're positioning this product. This is highly innovative. You can charge a lot of money for this, but your market is not going to be very big. And then once you have exhausted these early adopters, you are bit by bit lowering your price and selling this into a broader market. The third one is a penetration strategy, so market penetration. So your goal with this strategy is to basically gain market share, rapid market penetration. So you're going to underprice compared to the other two, which means that, or even underpricing your competition. You're going to get a massive amount of volume very, very quickly, hopefully, and you're able to scale in terms of volume terms. So obviously, you need to think about the long-term strategy here as well, because market penetration a lot of times is not a profitable strategy at all. So you're going to lose money in the short run, but in return, you're basically acquiring a certain level of market share. So if you are able to turn that market share that you're buying into profit later on, then that's great. If you don't see a path to profitability with a market penetration strategy, then I would be cautious about implementing this strategy. The fourth one is brand building. So this is about building credibility. This is something sometimes called logo farming. So the idea is to acquire influential clients, to leverage their names. Hey, this industry leader is using my product, so you're projecting quality into the market. By having these clients. Oftentimes, your strategy will depend on your product, on the market you're in. You might not have the same strategy in all of your markets, so you might have a difference of strategy in different markets. At the same time, competition obviously plays a role. And most importantly, what are your objectives? You need to think about your short-term and mid-term objectives before you select your strategy. Oftentimes, you will also run a blended strategy, maybe for different types of products in your portfolio. Once we have the strategy clear, we can move on to the price setting itself. There are three basic price setting principles, starting again with the most conservative and classical, which is cost plus pricing. So this is very, very simple. You're basically looking at your cost, you're adding a profit margin on top of that. Simple, you're done. Is it really that simple? Well, you need to have some idea about volumes so that your gross margin is big enough to absorb your fixed costs and your, accumulated R&D costs, etc. But this is a very simple strategy. You know your own costs, hence you can easily calculate what your minimum price should be. This should be really all about minimum price. Cost plus pricing is, probably being used by, 70, 60, 70% of the market. Again, it's a great strategy if you know your cost and if there is actually a variable cost. Obviously, if you're a SaaS company and you don't have any variable cost, cost plus is not the greatest strategy in the world. The second price setting principle is competitive pricing. So this is a market-aware strategy. Here, you're setting your price based on your competitors. You can underprice your competitors, you can match your competitors' price, or you can put a premium on top of your competitor's price if your product is considered to outperform your competitors. Obviously, you need to be able to explain these differences. So if your product has no competitive advantage over your competitor's price, putting a premium price obviously is not going to work. Oftentimes in innovation, there is no competition. So what are you competing with? Think about that. This might be the classical solution to the problem that you're solving. So this is not necessarily a competitor as such, but it might be a different way that people are trying to solve the same problem that you are solving with your product. The third one is, considered the gold standard of price setting, which is value-based pricing. So here the idea is that we understand the perceived value or benefit that we're creating for our customer. This basically is, what we talked about in the last video, really trying to quantify our customer's perceived value and then strategically capturing a portion of that value. Rule of thumb, 20, 30, 40% of value capture is great. Anything beyond that, you're going to seem very, very expensive to your customers. Sometimes we have a blended approach between pricing strategies. Sometimes we just want to understand what is our minimum price given a, let's say, cost plus approach, and have a benchmark of what value-based pricing might be without trying to capture the full value-based price level, but position ourselves somewhere in the middle to still be somewhere above cost plus, but maybe we're not price discriminating on each segment or each customer. So there are a lot of blended approaches that we can implement here, which are still better than a pure cost plus. Let's talk about our monetization mechanisms. What is a monetization mechanism? This basically means it's the way we collect value or the way we collect money from our customers. It's our revenue model. So the easiest one is one-time payment. This is a single payment, works very well for hardware, any kind of physical product, or physical services, so consulting services, construction, something like that. The problem with one-time payments is if you want to maintain your level of revenue, you need to constantly keep selling. There is no recurring income that you're generating. So you need to make a sales effort in every period. And if you want to grow revenue, you need to put additional resources into sales. This is not the case with recurring revenue. So, for example, if you're making a subscription type of plan and you're having income in each period, then your total revenue will grow in each period as you're signing up additional users that are paying this fixed fee. When we're talking about recurring revenue, we can look at either having a fixed subscription-based fee, which is very predictable revenue. It's great. We can have a variable fee or a usage-based fee. So this is this idea of pay-per-use, which has a less predictable revenue characteristic, but it is slightly better at capturing different levels of usage or different levels of value that your customers are generating. So if your customers are very different in terms of the level of usage and the level of value that they're getting from this product, then a variable or usage-based model might be a better way to really capture the right amount of value from each customer. Another way of capturing value would be with an outcome-based or performance-based model. Basically, here you're receiving payment on result. This could be, you're saving money for your client and you're getting a percentage of those savings. Outcome-based is fantastic because it creates a lot of trust for the customer, and it can really help you to penetrate that customer account. But the problem with outcome-based is also that you need to have the right metric in place to objectively measure the outcome and then to calculate the payment. So if this metric is not unbiased and objectively measurable by both parties, outcome is just not going to fly. We have indirect models. So think about indirect monetization being advertising. This could be sales of your usage data, right? So here the revenue really comes from a third party. It doesn't come from your user. Think Facebook, for example. There are also hybrid models, and these can be combinations of a lot of the things we've talked about. Typically, what we're seeing in the market are hybrids between fixed and usage-based. So you would charge a fixed fee on a recurring basis and a usage-based fee depending on the usage of your product. So this can be, your mobile phone subscription. If you're having, X amount of gigabytes for free on data, and you exceed that in your subscription period, then you will need to pay extra for an additional amount of, gigabyte, minutes, whatever. Another very famous hybrid model is the freemium model. What is a freemium model? Freemium basically is a free use of the core product forever. Freemium is not a free trial, right? It's free use of the full product with enough functionality for this to be useful forever, and a premium paid plan where customers have additional features or can go beyond certain limitations of usage. Maybe they take out the advertising, something like that. Word of caution with freemium models, typically conversion rates tend to be very, very low. So we're looking at, below a percentage, below 2% is very common. So don't expect to monetize a lot of users with the premium plan, and think about a way to have monetization also on the free plan. So this can be advertising, this can be, sales of data, etc., third-party income. I also promised to present you my strategy framework. From my point of view, pricing really is more than, just value capture. It is, brand positioning. It has to be aligned with company objectives. It has to be aligned with the value proposition, the segmentation, etc. My framework consists of 3 main layers. The foundational layers, this basically ties together your company objectives, with your core pricing strategy and your brand values. So here you're deciding where you want to go, and you make sure that this is aligned really with how you want your brand to be projected in the market. The second layer on top of that is the value layer. So this layer defines your target customers. It really defines your offering and feature bundling, and it narrows down your value proposition. So again, this is segmentation, value analysis, value proposition. Who am I selling to and what? The final layer is the pricing mechanics layer. So here it is about the price setting. It is the monetization model, as we have just discussed, and it is things like pricing psychology, or channel strategy, etc. As I said, I will be doing a full series on pricing, so stay tuned and we will discuss this in the full series. I also wanted to discuss a couple of common pitfalls in value capture. Typically, what I see is that companies tend to talk about pricing really late in the game. The problem here is that if you build your product, you do your lean innovation cycle, you've built all these features in. A lot of these features actually might be nice to haves, which makes your product really, really expensive. So you might create this, perfect product that later nobody wants to pay for. And this is a problem because you will need to lower your price in order to bring this to market, and you're basically justifying, you're jeopardizing margin in the long run because you have not done this analysis on willingness to pay early in the game. So what I recommend is, as early as possible in your innovation cycle, start talking about willingness to pay to your customers, as well as talking about features and other customer discovery items, and make the product in a way that you're having a cost ceiling that really limits the amount of features that you can throw in for a specific segment. And also think about segmentation as early as possible. The second issue I see a lot as common pitfall is around the value itself. Lack of understanding of the customer value or underpricing value. So a lot of times companies think about, this only costs me X, Y, Z, so I'm charging $10,000 for it, and you're generating $1 million worth of value for your customer. So you're walking away with 1%. That is not enough. You should be walking away with a higher percentage of value. Or vice versa, if you don't understand the customer value at all and you're not able to measure it, you might put a price point that is just completely misaligned with how the customers are thinking about value. Oftentimes, we're ignoring competition, or we're so incredibly focused on competition that we're not thinking about, what we actually should be doing. Sometimes competition seems relevant, but they are not. Maybe they're operating in a completely different market. They're not even there where you are. So why bother with this competition? Try and assess whether or not your competition is relevant to you, and make sure you're not overly focused, but also don't ignore them completely. Another big issue in companies is that often there is no clear pricing strategy whatsoever, and there is no clear ownership of pricing within a company. Who owns the pricing? Is it sales? Is it marketing? Is it product? Is it the CFO? Identify an owner. Obviously, you need to involve the different departments whenever you're making a pricing strategy decision, but there should be a clear owner of pricing in your company that builds up the hypothesis, revisits pricing on a regular basis, and drives strategy decisions with the rest of the team. Overcomplicating pricing is a big problem. I have seen pricing plans that nobody understands, not the salespeople and the customers even less so. So if you have a lot of different fees and then chargebacks and discounts and whatever, keep it as simple as you possibly can. If your pricing is too complicated, nobody's going to love your product. These type of pitfalls obviously can be avoided with the proper pricing discipline. So I am again providing you with a self-check audit template that you can download. And what I want to do is to run through the following audit questions. First, is pricing aligned with my customer value metric? This is super important. How are your customers thinking about value creation? What is the metric that they're using? And do we use the same metric for our pricing, or are we disconnected? Next, segmentation. Is our pricing tailored to our target segments? Do we even have target segments, or are we trying to sell with the same price to everybody? Selling to startups versus multinational companies. It is going to be hard to apply the same pricing across the board for companies that are very, very different. How does your price compare to your competitors? If we have a premium price, is this justified by differentiation? What are we trying to do? Being premium, parity, being a budget player to grab market share? Is my competitor going to react if I'm, underpricing them? How are we positioning ourselves to competition? Then, costs. Are we covering costs? Are we able to actually make a profit at some point? Here we need to understand, our direct costs, and we will be talking about unit costs next time, but cost of acquisition, we want to understand what is the lifetime value of this product. We need to understand the direct costs, and we need to make an assumption of minimum sales product volumes in order to understand if at that volume we're able to recover fixed cost and R&D investment. So understand your costs, make projections on volume, and see if you're able to break even at that volume, and do those volumes actually make sense with respect to your market size. Next, monetization fit is the type of monetization mechanism that we're using, our revenue model. Is that actually working for our customers? Is this encouraging the desired behavior from our customers? So, for example, if you have a recurring revenue strategy with a usage-based variable on top, how do you design this in a way that you're not curtailing usage from your customer? You want to encourage a certain behavior. Think about the behavior that you want and see if that pricing strategy that you have designed turns your customer off or actually pushes them toward that outcome. Clarity. Is your pricing strategy simple, transparent, and easy to understand? If the answer is yes, fantastic. If it is complicated to describe your pricing and it depends on 1,000 variables, then you might want to tone it down a little bit. Final note, pricing is an ongoing strategic process. You should be revisiting your pricing on a regular basis. It's not something that you do once and you're done forever. So keep that in mind, revisit your pricing, put somebody in charge in your organization that owns the pricing process, and make it one of their objectives. You should be looking at this, quarterly, maybe annually, depending on, what stage you're at. So that was our deep dive into value capture. As I said, I will be doing a full series on pricing strategy, so stay tuned for that. In the next video, we are going to talk about unit economics. So we will be zooming in on that gross margin and think about anything that happens from revenue to gross margin, basically. In the meantime, like, subscribe, and share my channel, please, and leave me some comments. I love those, and thanks for coming. I'll see you in the next video.